Instead of seeking corporate sponsorship for this event today, we actually partnered with 5 other professional service organizations here in Atlanta, all doing great work. You have the CAIO organization, that's the Chartered Alternative Investment Analyst organization. We have NASP, the National Association of Securities Professionals, the Association for Corporate Growth in Atlanta, and the Southeastern Hedge Fund Association, and as well the Georgia Securities Association, who helped put together our panel here on financial literacy along with NASP. All right, so we'll go ahead and get started. So since we're putting investors' interest first, it makes sense to ask them what they want. And so today we're very fortunate to have the head of the Future of Finance Initiative at the CFA Institute, Rebecca Fender, with us. Rebecca previously worked in the education division at the CFA Institute. Rebecca developed conference agendas and recruited speakers, including the flagship annual conference. Prior to joining the CFA Institute, she was a vice president at BlackRock, and she also worked at Cambridge Associates. She graduated with an AB in economics from Princeton University and an MBA from the Darden School at University of Virginia. Thanks, Rebecca.
Thanks, John, and thanks to the entire board here at ASFIP for putting together a great program. I'm really looking forward to all the rest of it. And I have the privilege, actually, at CFA Institute, based in Virginia, to work with CFA members around the world on these different activities. And I think there are probably about 80 different societies that are currently doing activities like this during the month of May. So I hope you'll find it also exciting that what we do here as we look at the future of finance in Atlanta is also being sort of multiplied around the world. So with that, let me tell you a little bit more about what we've been working on in terms of some research and content that we hope can be helpful to our members to drive the industry forward. So, the Future of Finance Initiative began about 3 years ago when our Board of Governors said, it's time for a little bit of soul searching. We've had the global financial crisis. Some things have really changed in a profound way in markets, both in reality and perception. And if we are meant to be the organization that represents the investment profession, we really need to be speaking on behalf of investors for what's right in the investment profession. So this is our objective, to shape a trustworthy and forward-thinking investment profession that better serves society. So we'll talk a little bit more about what does it look like to be trustworthy and how can we really be forward-looking. John mentioned already the Statement of Investor Rights, and that was actually kind of what we kicked off this initiative with a few years ago. The reaction we've got has been pretty amazing. These 10 principles were actually from our code and standards at CFA Institute. We looked at those which had been written for our members that they comply with every year, and we just essentially changed the pronouns. We said, what does this mean for our clients? What should they expect? It isn't going to be surprising to you, anything on that list, but this is really core to who we are and what we stand for. So you'll see this is actually a picture from our current ad campaign, and it's central to that. These are people who are putting their clients' interests first every day. And as we think about, again, what does this mean, I'd mention 3 different things that you can consider. First, take things like these materials and for the Statement of Investor Rights and others, and share them with your clients. Have an open dialogue about how you are working in their best interest. Secondly, look at your organizations and how you have worked your governance and incentives in order to do the best for your clients. We also have things like the Asset Manager Code of Professional Conduct and the Global Investment Performance Standards that are helpful tools in this regard. And I think what's been interesting is in the last few years, we've seen a lot more interest in these codes. 74 of the top 100 investment firms comply with the GIPS standards for how to present performance, and about 1,300 firms globally now have adopted the Asset Manager Code of Conduct. Many consulting firms are also using that in the RFP process. And lastly, really understand what your client's goals are. I think we know that as something that we should be doing, but sometimes it's not always that straightforward, what that means. What are those hopes and dreams of our clients, and how do we turn them into reality? So that's where we'll focus now. So when we talk about trust, and John again mentioned that a little earlier, sometimes it can be a little bit of a fuzzy concept. Does this really matter? We know you need trust for two parties of a transaction for it actually to happen, but what's the bottom line value here? As we look again at this slide, where we see financial services ranking pretty low compared to other industries, we have to ask, at what stage do we break trust and find a lack of participation in the markets? So I think we already see this a bit with millennials that are choosing not to invest in the same way as prior generations. But to give you a little background on what we did here, we partnered with Edelman Berlin, which is a major market research firm that has been studying trust levels for about 15 years. So they go around and they ask the general public, how much do you trust each of these industries to do what's right? And again, financial services has generally ranked toward the bottom. But we said, what happens if we ask investors, those who know the system a little bit better? And what we found was it's a little better. The retail investors said about 61% of them trusted the industry, and 57% of institutions, so the pension funds, the endowments and foundations and so forth. But we asked 3,200 individual investors in 10 markets and 500 institutional investors these questions. And I'm just going to give you a few little highlights from it to whet your appetite, and there's a full copy of the report if you'd like to take it home. Also, as we tie back to the rest of what we'll be talking about today and the drivers for change, I would encourage us all to think about the role industry can play versus regulation. This comment from the Secretary to the Treasury in Australia just notes that everyone in financial services should be looking toward some change, and we really want to avoid unintended consequences of regulation. So hopefully some of these items will drive us toward a better culture and conduct that will avoid those consequences. As we looked by market, we studied 10 markets. And you can see actually that there are some fairly significant differences in perception. We see much higher levels of trust in Asia, 89, 90% in China and India. Now these tend to be characterized by newer investors, younger investors, and of course they're in economies that you've been seeing very high growth levels. So I think it's interesting as we move toward more and more of a global economy to see what some of these different perceptions are. Now I'd like to talk a little bit about sort of the life cycle of a client, right? And so first of all, we see that trust is very important when investors are considering who to hire as a manager. We found, and actually we did this study 3 years ago as well, and the findings are consistent, that the number one answer people gave to what's important in making a decision to hire an asset manager was that they need to be trusted to act in my best interest. This was quite a bit higher actually than the ability to achieve high returns. I think with that understanding of putting your client's interests first goes ethics, competence, and a lot more. We then asked both sets of investors, what are really the top actions that firms could do to show you better, to build trust and improve relationships? So these were the top 5 that institutional investors gave. Right up there together at the top, we have acts in an ethical manner in all our interactions, and that they fully disclose fees. So it's interesting that one of the consistent themes we saw was transparency. People obviously want returns, and they want fair levels of fees, but really it was the transparency and disclosure that was the most important to them. We also found, and this time around in the study, that data security is more and more front of mind for clients. So I would keep that in mind. I don't think we talk about it so much yet at CFA Institute, but it's definitely a growing area of concern for our clients. And then, once you've got clients into the door, the question, of course, is how loyal are they? And so we asked about their likeliness to recommend the firm they work with. And globally, about half of investors said they would recommend their current firm. A little better in the U.S., actually, 62%. And also in the U.S., you had a few more people that were passionate about that said they were extremely likely to recommend their firm. But I think these are helpful to let us know kind of where we stand and how we can help our clients know more about us. Of course, if somebody's going to recommend a firm, the question is, do others listen? We asked retail investors, who do you trust most to give you investment advice? And here we're glad to say that the personal financial advisor ranked number one, although not everybody that was surveyed necessarily had a financial advisor. Once we screened out for that, it was more than 50%. So again, though, if we think about global differences, in Germany, the number one answer was online research. And in Singapore, it was friends and family is who they trust most to give them financial advice. So we can learn more as we ask our clients again what they're looking for. So methodologically, what we did here, of course, was we asked, what's important to you? And how are we doing, right? How satisfied are you with what you've gotten? And that's given us then a gap where I think we can look to make some improvements, and whether it's in actual practices or communication that's not maybe getting through. So top gaps between expectations and satisfaction were again around transparency, clearly explaining all fees and costs before they're charged. Again, protecting portfolios from losses, returns are going to be up there. And then again, a lot more on disclosure. So I would urge you to keep this in mind because these are factors within our control, right? Markets may be uncertain, but these communication, these disclosure items are fully within our control. And then as we kind of round out the life cycle, why do clients leave? These were the top 5 answers they gave. Underperformance, increases in fees. Again, you see data and confidentiality up there. I would note that only 60% of people said that underperformance was the main reason they would let a manager go. So we know that that's important. Keep in mind all the other things you do day to day to manage your client's portfolio and to help them reach their goals. Those things really do matter. And lastly, after we asked, what do you want? What are you getting? We said, is there anything you pay more for? And these items here actually are all things that where more than 25% of the respondents said they would pay more for these things. These are really around personalization, better understanding tax and estate needs, working as a problem solver and a partner with institutions, and understanding really their liabilities, and then client service and also very qualified investment professionals. So the training that you do matters then to these clients. So the second half of our charge was to be forward-thinking, trustworthy and forward-thinking. So we asked these clients, where do you think things are headed, right? And a couple of very interesting findings. First, we asked, how likely is it that there will be another financial crisis in the next 3 years? And about a third of investors said they thought there would be one. In the US, it was 25%. So now, I don't share this to say that this group has better knowledge on whether or not there will be a crisis than anyone else, but to let you know the mindset of your clients, that 1 in 3, 1 in 4 clients you're working with are very concerned about another financial crisis. Now, the kicker here is that we asked then, how well prepared do you think your current firm is to manage through a crisis? And only about 50% said they were well prepared. So I think the lesson here is that, yes, things will be difficult when a crisis comes, when and if a crisis comes. But it's incumbent upon us to let our clients know that we have policies in place, we are ready to respond, and we'll be ready to communicate proactively about what's happening. If you have a plan for crisis management, great, let them know. If you don't, think this through. And so again, these are kind of the three key takeaways. Control what you can control. There are many factors about managing these relationships and building trust that will serve you well throughout the market cycle. Share your plan, and also keep in mind the urgency in times of crisis, that these are times when clients will be watching closely. About 27% of clients said that they would reevaluate the use of their managers based on performance during a crisis. The second forward-thinking question we asked was about technology. Obviously on everybody's mind, we said, in 3 years' time, which will be more important to you? Having access to the latest technology platforms, or having a person help you navigate your strategy? We saw major differences across markets. Here in the US and in Canada, they're most interested in still working closely with a personal advisor. And I think especially, we surveyed people across the wealth spectrum in this survey, and I think particularly we found that ultra-high net worth are still going to be very much interested in those services. Of course, the next question our members asked was, what does this look like by age? And no surprise there. So the younger the investor, the more they're looking to technology to meet their investing needs. Meanwhile, actually at CFA Institute, we asked our own members. So these again were the clients, but we asked our members, what do you think will be important in terms of technology 1 and 5 years from now? Because when we say fintech, it can mean a lot of different things. When we drilled down, our members said robo-advisors really are the biggest factor that will change our profession going forward. And second to that, blockchain technology, probably in the next 5 years, will change a lot on the infrastructure that we're working with. So, key takeaways here, again, the trend toward robo-advice is meaningful, and it's coming quickly. We would say use technology to help you. So think about the opportunities here for improving processes and operations such that you can spend your time working on the parts of the process and the relationship that really must be done by humans. So with this, just a few last comments before I wrap up. With all of the changing dynamics in our industry, there's just a lot to take in, but we're really at a very exciting inflection point for the industry. There are opportunities for those that are looking at their business models and are looking to adapt and be flexible to better meet the needs of clients going forward. So I would note that we need to be aware not to be defensive, that markets are out of our control, we can't do anything. It's our responsibility to take the uncertainty of the markets, use our training to do the best we can for our clients, and then let them know along the way what we're doing on their behalf. But this new model that I'm recommending has to be characterized by some key aspects. We must be very responsive. People want things now. They want them to be user-friendly. They want them to be customized and confidential. So these are the factors that will differentiate firms going forward. But demographically, we have a wave of people that will be looking to invest more and more in the markets. So assets under management are likely to rise significantly, and there will be huge opportunities for those that can adapt in these ways. So I'm very excited to be part of this and want to thank you again for your time. At this point, I think I want to hand it over to Greg, who will take us to the next part of the program.